You know, actually, the first thing we're going to do is, all right, well, now that we've gone over the exam, let's talk about internal rate of return. Since we spent a little bit of time going over the exam, I'm not sure whether we'll have time to get through this additional bond calculation. We'll just have to see. So the relevant announcements that are on your plate at the moment are that the next homework assignment, homework 7, is due a week from today. You've just submitted homework 6. Now homework 7 is due a week from today. And then remember, I'm going to keep emphasizing this project because I don't want you to lose sight. That's really important. It's a big chunk of your grade. And oh, have I got a typo in the announcements there? Let's see. Homework 7. Friday the 12th. Oh, okay. Yeah. Thanks for noticing that. So homework 7 is supposed to be due on Friday the 12th. I looked on the wrong row, so let me fix that. The course schedule is right, so it's Friday, March 12th. So the end of this week, rate of return 1 project. All right. Thanks for noticing that. Today we're going to talk about internal rate of return, and we touched on that during our class meeting last Friday. So we're going to continue talking about finding that rate that brings balance between the inflows and the outflows. And this is the diagram that we went over in Friday's class where we calculated using the unrecovered investment balance approach. We calculated over time how much of your initial outlay had been recovered and what was the interest rate that brought equilibrium between the inflows and the outflows. So we've already kind of touched on internal rate of return already, but we're going to get into more of the depth today. And remember, the point of this figure was to identify the break-even point. How many years until the inflows and the outflows were in balance? Now, as a part of the illustration for today's class, I want to point out that you can get different interest rates if you go to different banks. A couple of years back, I went and got auto loan rates for a 66-month loan. Huntington Bank was offering 4.72%, but Star Federal Credit Union, Star USA Federal Credit Union, was offering 2.75%. So we're going to take a look at what are the implications of something like that. If you have a high interest rate versus a low interest rate, what is that going to do to the overall amount to the profitability of a project, and whether it's even feasible to undertake an example purchase. So we're going to consider that in the case of a new truck purchase. This was in 2016 that I took a screenshot for a particular vehicle, but this Super Crew F-150 had a net price after a couple of incentives of $54,000. And I have to believe that probably the new model years may be even a little more expensive because that's the way things go. But we're going to take a look at what if you're going to buy this truck and put it into service for business. You know, you wanted to try and make money from this, and you estimate that if you buy the truck, it's going to allow you to get an extra $900 a month in new revenue. So that's over and above like the cost of insurance and fuel. Would it be worthwhile to buy a truck for $54,000 when you're going to get $900 a month in new revenue? And so to do that analysis, what we'll have a look at is a spreadsheet that considers these two different interest rates. So give me just a moment to open up my spreadsheet here. All right, so here's our truck, and we've got a 66-month time horizon. So each one of these rows represents a 1-month period. So our period is a month. And we're going to look at what if you got the loan for 2.75% or what if you got the loan for 4.72%. These are the two different examples. And so we'll start off with 0.0275. So that's the interest rate per year of the lower Star USA Federal Credit Union. And so on a monthly basis, that interest rate is the annual rate divided by 12. Okay, so this is my interest rate per period. And we're going to spend $54,105 for the truck. And we said that we think we can get a revenue of $900 a month. All right. So the amount at time zero, this cost is an outflow, so I'm going to say equals minus of the initial purchase. And so we have an outflow, we're spending money at time zero, and then we have this 900, oh, I'm sorry, this should say month, not year, because these are monthly periods. So then we have 900 each month. I'm going to anchor that reference and then just continue it through the entire spreadsheet. All right. Now we'll find the present value of each of those using the PV function. And we're going to use the rate per period. So here I'm going to anchor the reference to the rate per period, and N is whatever row we're on, skipping over the payment field, and so it's the minus of the future value. Now in this case it's cell B11. I can't click on it because the center formatting is on top of cell B11, so I can't click on it, but I can just type its reference like that. So no surprise that 54,105 is equal to itself when there's 0 years of discounting, but 0 months of discounting. But I continue that formula through, and so the $900 1 month in the future has a present value of $898, and the longer you go in time, that $900 a month of revenue has a smaller present value. So we've seen all this before, but let's add it up. Let's add up the total present value of this entire opportunity, including the inflows and the outflows. So I'm going to just do a sum function and select this entire range, including the purchase of the truck and all of the future revenue through the course of that loan. And what it says is that you're going to get $963. That's the present value of your profits after you pay off the bank. So the 2.75%, that's the interest that goes to the bank. So each month you're taking your $900 and you're giving some of it to the bank to cover the cost of the principal as well as the interest. And so the $963 is the leftover money that isn't due to the bank if you had a 2.75% per year loan. So that was at the lower interest rate. So our conclusion would be, if the loan rate is 2.75% per year, then this project is profitable. Not very profitable though. Think about it. You're going to all of that trouble and the total present value of your profits is $963. So that's a kind of a marginal opportunity. But things get even worse if you have to pay the bank 4.72%. So let's change out, instead of the lower interest rate, what if we're discounting our future revenue at a higher rate? So think about this in conceptual terms. What it means is all of those $900 in the future, the revenue that's coming to you, your inflows, are going to be discounted more heavily than they were before. And so the outflow is the same, but the inflow value is less because of the higher rate. So 0.0472 means that you're going to lose money. That if you bought this truck and you only got $900 per month in revenue, once you paid off the bank, you'd still be in the hole. You would have done all of this and lost money. And so the key takeaway is that interest rates matter. If you have to pay a high interest rate, it can make a project not worth doing. If you have a low interest rate, then that can make some projects that otherwise wouldn't be attractive suddenly possible. All right, so the internal rate of return is that interest rate that brings balance between the inflow and the outflow of cash. And in decision making, we have to apply a decision criteria. You may remember that in present worth analysis, for example, the decision criteria is that when you discount your future amounts to the present, if the sum is positive when you discount at the MAR, then the project is acceptable. And if you're doing multiple alternatives and you're comparing those and they're mutually exclusive, then your decision criteria is choose the alternative with the highest positive present worth. So we have decision criteria if we're comparing and making decisions on internal rate of return as well. And so the internal rate of return, we've already talked about how that's the interest rate that brings balance between the inflow and the outflow. And so what we look for as a standard is that you shouldn't have a negative internal rate of return. You should only use it when, you should only calculate it when there are revenues and when the revenues are greater than the costs. And there's no like physical interpretation of a negative rate of return. It's solved most easily using Excel or graphically, and we'll use Excel. And our criteria is that if you solve for an internal rate of return and it's greater than or equal to the MAR, then you can accept the project. But if it's less than the MAR, then you don't accept the project. So internal rate of return is great for initial screening. It doesn't always tell you which alternative is best, but it can tell you if an alternative is acceptable or unacceptable. And that's a really important thing, is you can't use IRR analysis to select the best alternative, just to screen out alternatives that may not be suitable. Okay, so the internal rate of return, I star, is the rate of return that's earned on an unrecovered investment balance. And you can think of it, if you are the lender, it's the rate that you're earning on a yet unpaid balance of borrowed money. So it brings equilibrium between the inflows and the outflows, and then at the end of the cash flow diagram, there's zero balance. So what we would do to calculate the internal rate of return if we had some cash flow diagram is we would either iteratively or using solver or the what's the other, goal seek is another one, where you're trying to find out what interest rate brings the present worth of all of these future amounts equal to zero. So we're going to be solving for an interest rate where the present worth of the revenue equals the present worth of the expenses. Here's the formula that makes it seem more complicated than it actually is. Like, I remember when I was a student, if I would have seen a formula like this, it'd make me feel a little bit anxious because it just seems so complicated. But the interpretation of this formula is just, we want to find some interest rate where the present worth, so the left-hand side of this says the present worth is equal to zero. So we want to find out what is the interest rate, I prime, that makes the present worth equal to zero. So the revenues minus the expenses are equal to zero, where we're taking all of the revenue to the present and all of the expenses to the present. So any amount that's not yet in the present, we take it to the present with find P given F. And K just means for whatever year that you're in. So if you're in year 1, you take it 1 year back to get it to the present. If there's an amount in year 2, you discount it 2 years backwards in time. So you get all of the amounts to times 0, and we want to find out what is the unknown I prime, what's the interest rate that makes it so that the present worth is equal to 0, meaning revenues and expenses are the same. So what we just looked at in Excel with the truck was when we had a low interest rate, there was a positive present worth, and when there was a high interest rate, there was a negative present worth. And so we could find, on this one, we could find out what interest rate is going to make it so that the total present worth is equal to 0. So is it 3%? 3% is too low. What about 0.035% per year? That's too high. 0.034. Getting close. That's actually good and close there. But there's a way to do home data what-if analysis, goal seek, where our goal is we want this total to be 0 by changing this rate. And so then Excel is going to keep changing the rate until this value is 0. And so this is the internal rate of return. So if you pay $54,105 for the truck and earn $900 per month for 66 months, then the internal rate of return is 3.401% per year, but it's compounded monthly. Okay, so internal rate of return is you're solving for the interest rate that brings balance between the inflows and the outflows. So that crossover point, where if your interest rate is too low, you get a positive present worth. If it's too high, you get a negative present worth. You just keep changing the interest rate until there's balance between the two. Warnings. You can use IRR analysis for initial screening. You can use it to accept or reject an alternative, but you cannot and you should not compare the internal rate of return of different alternatives, because the IRR alone doesn't identify which project will be most profitable. I'll prove that to you with an illustration a little bit later. The real reason why that is that there can be different amounts between projects, different initial investment amounts. And so you want to maximize profitability, not maximize rate of return. The other warning and assumption that you need to be aware of is that the internal rate of return assumes that whatever profits you get for a project can be reinvested back into that same project. So we'll talk more about the implications and limits of that on Wednesday. Okay, so here is today's in-class exercise. Let me pull it up. It's ICE 19, internal rate of return, on the other screen. All right, so I've given you a cash flow diagram, and I'd like you to use Excel to find the present worth of this at 7% and at 8%. And so what you need to do is translate this cash flow diagram into a cash flow table. And so what you're going to have is amount. Well, first of all, up here, of course, we have some cell where we put the interest rate. And then you have year, amount, PV of amount. And then we want to find out what is the present value at 7% and what's the present value at 8%. So at 7%, what you should find is that it's positive. At 8%, you should find it's negative. So let me pause for a moment and give you some time to take this cash flow diagram, translate it into the cash flow table, and then find the PV of the amount and find out how much is the present worth at 7% versus at 8%. All right. I'll pause the recording and give you some time to begin those calculations. Okay, so did you get that the present value of the project is going to be $26,905 if it's at 7%? Okay, so that's at 7%, and if it's at 8%, what we can do is copy, let me see if I can just paste this whole thing, and then change this to 8%, and then I need to adjust the reference here, because right now it's looking over at the original interest rate. So if I just drag that over sideways to the new interest rate and drag that through, then it shows if we have a 7% rate of return, a 7% discount rate, then the project is profitable. So our interpretation of this is at I equals 7%, the project is profitable, but then at I equals 8%, the project is not profitable. So the internal rate of return is the interest rate that's going to be giving us a sum of the present worth equal to 0. And that's what it asks on the second part of this. Okay, so at 7% and 8% we calculated the present worth, but now it says copy the cash flow table onto another sheet and then use goal seek to determine the internal rate of return. So what I'm suggesting is just calculate, copy all of this into a different sheet. So if you press Control C, oops, highlight it all, Control C, and then start a new worksheet, Control V to paste it, and all right. Keep changing the interest rate until you get what amount of interest will bring the total to 0. Let me pause for a second so you can do that. Next part. Okay, so it says use goal seek to find the value of the internal rate of return. All right, so what we want to do here is make it so that there's some interest rate that makes the total equal to 0. So here on the Home tab, click to Data, What If Analysis, Goal Seek. And our objective is that the total should be equal to a value of 0 by changing the interest rate. Okay, click OK, and it'll go through, and it gets, you can see if you click on the cell, it has quite a lot of digits here. One of the questions came up in the chat box, you know, how many should you quote it to? And I think what's reasonable is to 100th of a percent. And so to 100th of a percent would be 7.63%. So that's how you can calculate it, setting it up with the goal seek. But the handout also says try using the function that's called IRR. So using the IRR function. And let me show you that. The IRR function is pretty convenient, but I didn't want to make it the only thing that you learned, because you kind of have to know in the background what's happening. So here we're going to do the IRR function. So I've just put this label in the cell next to it so I know what's the amount that I'm about to have in cell B16. So equals IRR and then parentheses. And now remember, the way Excel works is it kind of prompts you and gives you hints on what sorts of values should go into each function. And it says just give values. And so the amounts in order, so the year that they're in, so I just select the range of amounts, not the PV of amounts, the amounts themselves. And so what it's going to do is it's going to, in the background, as soon as I press enter, it's going to discount all of those future values to times 0, and it's going to keep playing around with the interest rate in the same way that we just did. So it's going to do an iteration, and it's going to run goal seek until it finds what interest rate brings equilibrium between the inflow and the outflow. So I'm going to press enter. It says 8% because it's rounded up. If I display more digits, then it's the same 7.63% that we calculated manually. So that IRR function is pretty convenient. It's a good way to double check. Just make sure that you use it on the amounts themselves and not on the PV amounts, because then you'd get the wrong interest rate. Okay, excuse me. So we do still have a little bit of time, so let's work on this bond practice problem. You can never have too much practice pricing bonds. All right, if you want to achieve an annual yield of 12%, what price should you pay today for a bond that pays $50 in monthly interest for the next 5 years and then gives a lump sum payment of $6,000? All right. Now, remember, the two ways that a bond has value is the present value of its lump sum payment. So there's a single amount in the future that you have to discount to the present. And then there's also the present value of the annual interest component of the bond. Okay, so let me pause for a second, give you a chance to just digest this. I just don't want to jump into the answer and rob you of that opportunity to think. But try and solve what is the value today. How much should you pay for the bond if you're trying to achieve a yield of 12%? All right, let me bring up the solution here. Let's see if I did it right. I wasn't able to find my previously solved PDF, so I just flew through it real quick. And let's see if we're on the same page. All right. Okay, so annual yield of 12%, but it is compounding monthly, so that means that the interest rate per period is 0.01, and there are 60 periods because it's 5 years of 12 periods per year. And the value now is going to be the present value of that lump sum $6,000 payment in the future, and then the present value of the recurring $50 per month. And so you find the factors for each of those. Here's the P/F factor. Here's the P/A factor. And the value of the bond should be $5,550.45. I know we didn't have a lot of time to go through that one, but I'm just wondering if anybody else had gotten that same value. I'm sure I'll scrounge the PDF solution that I had previously prepared, but just keep in mind that you'll have a bond problem, if not on the next exam, you'll have one on the final exam. So it's important to kind of keep current in how to solve those bonds. All right, it's 12:51. We've got 1 minute over. I apologize for that. I don't like to keep you late. Just remember that homework 7 is due on Friday. And also start thinking about that project if you haven't already. All right, everybody. Hope you have a great day. I'll see you next time.